Before we start the video, please take some time to read through the important notes and disclaimer. Do note that investments always involve risk and the possibility of losses. Any reference to prediction, projection, forecast on the economy, stock market, bond market, or the economic trends of the markets or past performance is not necessarily indicative of and is no guarantee to the future or likely performance of your investments.
Hi everyone, I'm Jalisa, investment analyst at AutoWealth. I'm here today to talk about the future of the new economies portfolio. Here with me is our Chief Investment Officer, Taizhi, who will kickstart the introduction of the portfolio.
Thank you, Jalisa. I'm really excited to introduce to you the future of new economies portfolio. This is our latest addition to our AutoWealth Plus offering. It is designed to deliver strong risk-adjusted returns by diversifying into China, Taiwan, India, and South Korean equity market. All of our portfolios are specially curated by the investment team to reflect a particular theme or investment strategy that aims to deliver strong returns. Our portfolio curation process can be simplified into 3 simple steps. First, extensive qualitative and quantitative analysis is carried out to determine the economies that will make up the portfolio. The ETF's weightage is then carefully constructed to replicate and track the MSCI Emerging Market Index. Our team then screened through over 10,000 available ETFs listed globally and select the best ETFs possible for your portfolio based on various factors such as diversification and risk-adjusted returns, etc. The process doesn't stop here. In fact, our portfolios are reviewed regularly to ensure that the underlying ETFs in your investment portfolios are consistently the best ETFs possible and the allocation weightage is relatively consistent with the index. Now, Jalisa will share more about why you should be investing in these emerging markets.
Thank you, Taizhi. Let's first look at the long-run performance of the 4 selected economies. In the last 20 years, all 4 economies have delivered more than 400% returns and a weighted average of more than 600% returns. And if we compare the performance of these economies against the MSCI Emerging Markets ETF as a benchmark, we find that China and India have outperformed the benchmark ETF with over 600% and 900% returns respectively, while Taiwan and South Korea have performed in line with the benchmark with over 400% returns. What about the recent performance of these economies? We all know that the first half of 2022 has been a challenging period for markets, fueled by the Russian-Ukraine war, rate hikes by Fed, and China's COVID-0 policy. While all 4 emerging economies experienced negative returns, by diversifying across the 4 economies, the weighted average of the portfolio slightly outperformed the emerging market sector. Now, let's dive into the 4 economies in greater details as we share the reasons as to why you should invest in them. First, let's take a look at China. Here, we see China's economy outlook from 2021 to 2023 compare against the emerging markets as a whole. In 2021, China experienced a GDP growth of 8.1%, which is relatively much higher than the emerging market sector. And despite the lower projected growth for 2022, which is likely caused by global events and Xi Jinping crackdown on the tech and property sectors, we expect to see China experiencing greater GDP growth in 2023 again with stability in politics after Xi's 3rd term. Furthermore, this economic outlook is supported by China's large-scale capital investment and household consumption. The first major component of China's GDP comes from its fixed capital investment, which makes up 42% of China's GDP. Capital investments in China have increased steadily each year from sources including foreign direct investments and domestic savings. The funds are used to build infrastructure and develop the various economic sectors in China to boost productivity, such as the Belt and Road Initiative, where countries along the Silk Road experience infrastructure development and economic integration. The next component of China's GDP comes from its high household consumption, which makes up 38% of the GDP. Final consumption expenditure hit 5.61 trillion in 2020 from 0.56 trillion in 2000, producing a compound annual growth rate of 12.2%. Their GDP per capita also reached a new high of over 12,000 in 2021 with a growth rate of 13.7%, implying that the Chinese have been experiencing increasing wealth and greater purchasing power over the years. Additionally, with the success of the major consumer platform such as Tencent and Alibaba, it further boosts consumption, which then led to an increase in GDP per capita and driving up purchasing power. The next economy is Taiwan. Taiwan's economy has fared relatively well during the COVID-19 crisis with a GDP growth rate of 6.3% in 2021. GDP is projected to grow at a rate of 3.2% in 2022 and 2.9% in 2023. While the country's growth potential has slowed down due to the impact of China's lockdown and weak consumer demand, we are still optimistic about its potential as Taiwan holds a strong leadership position in the semiconductor industry and has proven its ability to recover against global crises. The Taiwan Semiconductor Manufacturing Company holds a 54% market share of the semiconductor industry globally. And with other firms such as UMC, Taiwan dominates the industry with a total market share of more than 50%. The demand for many digital products, including cloud infrastructure and electric vehicles, requires the advanced chip made by Taiwan's semiconductor companies and solidifies Taiwan's position in the industry. Furthermore, Taiwan also proves itself to be an economy that bounces back quickly from downturns in the market. This chart shows the performance of the Taiwan Capitalization Weighted Stock Index. We see that after downturns from the US-China trade war and the COVID-19 pandemic, shown by the red areas, Taiwan was able to bounce back quickly as seen by the green areas. Despite market downturns, Taiwan managed to increase its exports by capitalizing on their strong electronics sector. Next, we have India. India is expected to be the fastest growing economy with a GDP growth rate of 7.4% in 2022 and 6.1% in 2023, outperforming the emerging markets as a whole. This robust growth is supported by favorable demographics, Modi's structural reforms, and its potential to be the next factory of the world. One unique opportunity for India's growth is its demographics. India is one of the youngest large nations with an estimated population of 1.39 billion and a median age of 29, and is poised to enjoy a prolonged period of demographic window opportunity where the ratio of the working age population is high and the dependency ratio is low. When the demographic dividend is supported by sound policies, India can increase wealth and reduce poverty, hence improving GDP per capita and propelling economic growth. India is also rapidly emerging as a favorable destination for FDI. Significant reforms such as lowering corporate tax rates and streamlining the labor codes has led to a sharp growth in FDI inflows, leading to an annual growth rate of 15.5%. These investments would help to improve India's infrastructure development and human capital, propelling economic growth. India is a service economy, with manufacturing making up a relatively small part of India's economy, approximately 14% of its GDP. Yet, India has emerged as the world's second most sought after manufacturing hub, signaling India's potential as the next factory of the world. Recently, global tech major Apple supplier Foxconn has announced to expand its iPhone production actively in India to diversify its supply chain out of China. This move by Apple is a testimony of India's potential to become a manufacturing powerhouse and should open the floodgates for other major conglomerates to follow suit. The last economy we have is South Korea. So South Korea's economy has fared relatively well during the COVID-19 crisis with a GDP growth rate of 4% in 2021. GDP is projected to grow at a rate of 2.5% in 2022 and 2.9% in 2023, supported by robust demand for Korea's exports and a capital inflow to high-tech sectors in the country. While the country's growth potential has slowed down in recent years with an aging population and weak productivity, there are still bright spots ahead. As an export-oriented country, South Korea's share of exports makes up 41.7% of its GDP, and demand for exports has remained resilient despite the pandemic and Russia-Ukraine war, supported by their manufacturing sector. The semiconductor industry recorded the highest performance ever and led the export growth, while automobile exports come in second. Medium-term outlook for exports remains positive, and South Korea's export growth is likely to accelerate further as China's COVID restrictions ease. As shown earlier, the semiconductor industry has led South Korea's export growth. South Korea is already the world's biggest memory chip maker, with the nation's two largest chip makers, Samsung and SK Hynix. With broader demand sources from automobiles and the Internet of Things, creating a circular growth trend for this industry, South Korea has announced to spend US $451 billion to solidify its leadership position in the memory semiconductor industry and increase its competitiveness in system semiconductors to become a semiconductor powerhouse in 2030. Another industry leading Korea's exports is automobiles. After a few months of launching their new EV models, South Korea car maker Hyundai has become the second most popular EV brand in the US, just behind Tesla, with a market share of 9%. As governments work together to bring down carbon emissions and promote EV adoption, the rise of Hyundai in the EV industry will boost South Korea automobiles export. Another area of interest is Korea's New Deal, which is set to be the blueprint for the country's future economic development. In 2020, the New Deal was unveiled as a national development strategy and consists of the Digital New Deal, Green New Deal, and an overarching policy support to strengthen employment and social safety nets. The Digital New Deal would lay the foundation for a digital economy by investing in forthcoming technologies such as 5G, big data, and AI, while the Green New Deal focused on transitioning the country to a net zero emissions economy. South Korea is estimated to invest US $114 billion in the New Deal to help create about 1.9 million jobs. Lastly, why do we allocate 10% to a minimum volatility ETF, in this case EEMV, in our portfolio? The minimum volatility ETF seeks to track the index composed of emerging market equities that exhibit low volatility characteristics, helps to provide downside protection for your portfolio. As seen from the left chart, minimum volatility has a track record of delivering market-like returns with less risk, as they have historically lost less during market declines while still capturing meaningful gains during upswings. During market volatility, EEMV is observed to lose only 68% of the total loss accumulated by the benchmark ETF. This is again proven true during the COVID sell-off period, where MSCI Emerging Market Index recorded a negative 15.4% loss, while EEMV recorded a slightly lower loss of negative 11.44%. All investment involves risks, and here are some key risks we should be aware of. For China, the zero COVID policy and central government crackdown on large conglomerates under the Common Prosperity Policy continues to hamper economic recovery. However, we can expect more easing of rules as the pandemic becomes normalized, and once President Xi secures his third term, there will be less impetus to continue harsh crackdowns. Next, Taiwan faces geopolitical and trade tensions with China, but strong backing from the semiconductor sector and resilience towards global crisis helps to cushion China's impact. India faces inflationary pressure driven by the Russian-Ukraine war and China's COVID lockdown. However, latest data has shown that inflation has peaked, and the Reserve Bank of India aims to bring it down to 4% within the next 2 years without too much of growth sacrifice. Lastly, South Korea faces an aging population, which leads to a shrinking labor force. This can be mitigated by lifting female labor force participation or encouraging older workers to stay in the workforce longer. Moving on, Taiji will share more on the potential risks and returns.
So, what are the risk and performance numbers like, and how does it perform when compared to a benchmark? Using the MSCI Emerging Market Index as the reference benchmark, the portfolio has significantly outperformed the index on a short run 1 year and longer run basis 3 years and 5 years. The New Economies portfolio has achieved a 5-year annualized return of 5.3%, while the index achieved an annualized returns of 2.63%. From a risk perspective, the portfolio's annualized volatility of 16.14% is also significantly lower than the index annualized volatility of 22.17%. On the maximum temporary drawdown front, an indication of downside risk, the portfolio has also performed better with a drawdown of 21.58% as compared to 31.15%. Overall, if we look at the Sharpe ratio, the portfolio has a Sharpe ratio of 0.26, while the index have a Sharpe ratio of 0.06. This implies that the future of New Economies portfolio is able to provide higher excess return relative to the risk taken as compared to the reference benchmark. As mentioned in our introductory video, the AutoWealth Plus portfolios are made up of 100% equity and tends to be more volatile than our AutoWealth Starter portfolios. So, who should invest in the futures of New Economy portfolio? This portfolio is ideal for investors who believe in the Asia emerging markets growth story and wants to seek exposure in these economies. However, as we are investing on New Economies as a whole, we want to caveat that the New Economies portfolio may not always give investors a double-digit return. Political stability and significant reforms takes time to implement and show meaningful results, and hence, time is needed for growth to manifest. Therefore, an investor should have a longer time horizon of at least 5 to 10 years with a high risk tolerance to withstand potential losses that may arise from market volatility. If you wish to start an portfolio, all you need to do is to follow 3 simple steps to create an AutoWealth Plus portfolio with us today. First, to open an account with us, you need to head over to our website and click Get Started. Next, you will create the AutoWealth Plus portfolio by clicking the Plus tab and follow the instructions to fill in your financial goals, information, and risk assessment. Lastly, you then pick the preferred AutoWealth Plus portfolio and fund your account. Thank you for watching till the very end. If you have any queries, please do visit our website or drop us an email to client services. Help us to improve our next video content by scanning the QR code. Do look out for the next few videos as we will deep dive into other AutoWealth Plus portfolios. Stay tuned. See you there.